Hello and welcome back to the fixed income securities series of NISM. So let's continue with the next chapter, that is chapter 2.5.3, bond with a put option. A bond with a put provision gives the right to the bond investor to seek redemption of the bond from the issuer before maturity date but at the prefixed put date. The investor invokes this right only when the market interest rate is higher than the interest in the putable bond. However, these bonds generally require discount at the time of redemption when the investor chooses to redeem the same before maturity. Chapter 2.5.4, Convertible Bonds, including FCCB. So, convertible bonds are the bonds issued by corporates, and such bonds get converted to equity shares at a specified time at a prefixed conversion price. The bondholder has the right to convert the said bonds to equity shares, and issuing company cannot refuse the conversion as it is agreed at the time of the issuance. These bonds are preferred by foreign investors who would like to test the company for some time before taking an exposure to the equity shares of that company. This is a hybrid security as the price of the bond depends on the market interest rate, equity share prices, and the rating of the issue. The agreed conversion ratio determines the number of shares the bondholder would get if he or she exercises the option of conversion on the agreed date. The conversion price is set at the time of issuance of the security. The conversion price is the conversion price and ratio can be found in the bond indenture or in the security prospectus. The convertible bond is ideal for investors seeking gain from rising equity prices as the conversion price is decided at the time of the issuance. An investor has to always calculate the value of the bond on conversion date, taking the face value and the future promised interest. If the stock acquired through conversion is priced higher than the value of the bond, then the investor would convert the said bond. There are mandatory convertible bonds that are required to be converted by the investor at a particular conversion ratio and price. Exchangeable bonds are like the convertible bonds, but these bonds can be exchanged for equity shares of some other issuer, and then issuer would take the risk of buying the equity stock from the market to exchange against the bonds. Typically, these bonds are exchanged for equity stocks for some group companies of the issuer. A foreign currency convertible bond (FCCB) is a special type of bond issued in the currency other than the domestic currency. In other words, companies issue foreign currency convertible bonds to raise money in foreign currency. These bonds are preferred by foreign investors as these are bonds but can be exchanged for equity shares if the same is uh, beneficial to the investor. Chapter 2.5.5, warrants. So a warrant is a bond with option rights. For a limited time, it confers the right to buy equity securities such as shares of the bond issuer at a predetermined price, exercise price. Warrants are derivative instruments like options that give the right but not the obligation to the investor to buy an equity stock at a certain price before expiration. As these are option contracts, it will have strike price, it will have strike or exercise price. Warrants can be American or European. An American warrant can be exercised at any time before or on the expiration date, but a European warrant can be exercised on the expiration date only. Warrants have call and put types, and these are traded in the over the counter or OTC market. So warrants are issued as a sweetener to bond holders that allows that allow the issuer to offer a lower coupon rate. Warrants can be separated from the bonds and can be traded in the secondary market. Covered warrants are issued by financial institutions who might have acquired these stocks and holding them in their portfolio. That's it for now. We will cover the next chapter in next video.